possible we're already live? I think it's setting up. You never know. You never can tell.
Just go. It doesn't matter.
Well, this is Value After Hours. I'm Tobias Carlisle, joined as always by Jake Taylor. Our special guest today, Tim Travis, repeat offender. You're back again. It's good to see you again, Tim. How are
Yeah,
you?
welcome back,
Great
Tim.
seeing you guys. Everything's good. Life's good. Can't complain. Glad we're getting some excitement in the markets and summertime's coming.
Yeah, so tell us a little bit about what you've been seeing in the markets. How long is it since you've been on? 6 months? We talk about the last
Probably
6 months.
something like that. Yeah, I don't think we've talked since like tariffs or anything like that. But I mean, like you guys have been saying for years, I think valuations were obviously really stretched. A lot of indicators were closest to 2000 in many different respects and indications. And so I thought it was really helpful to see the bear market that we did see. And it's so interesting. I mean, it really does echo 2020 a lot, where the market recovered so rapidly once again. And I think right now a lot of people are kind of thinking that same playbook, buy the dips, you can't lose, that sort of thing. But now once again, valuations are a lot more stretched once again. And it's tough to find good value out there, in my opinion. There's certain pockets, I think, where there's really good opportunity, stuff that's been impacted by higher rates or lower energy prices, perhaps. But in general, I think the market's kind of gotten a little bit ahead of itself again. So we'll see what happens.
It's interesting to see like the softer, more anecdotal things like uh, Pomp's got a SPAC, Chamath's back with some investment opportunity.
hmm
Does anybody ring a bell at the top, or
Some victory
you
laps.
just get the victory laps?
Yeah, MicroStrategy. I mean, people love the and all those kind of like yield plays that have come out of that stock. I know a lot of people that are really ramping up their activity in that. We had a client, wonderful lady, and she wanted to drop all of her fixed income and focus on the MicroStrategy yield plays. So it wasn't our
Jesus.
recommendation, but there's a lot of speculative fervor out there. And I mean, look, you have the administration there embracing crypto, which is a big difference. Like that's a big change, and I'm not a big crypto guy. I've never bought any myself, but when the United States government is kind of putting some impetus behind it, I think it does add more legitimacy than it did prior. Whatever your thoughts are on it, but still not for me.
What kind of yields was she being promised in that
I
whole
want to
thing?
say it's like 13 or
Oh,
something like that. It's high. It's high. I mean, they're just leveraged bets. I mean, MicroStrategy itself is a enormously leveraged bet, and then they go beyond that. But we definitely talked kind of sprinkled in some conservative. Whenever someone shows an interest in crypto, I mean, as long as they can afford it, I always recommend maybe scratch that itch a little bit, because what I've seen happen is if they don't play it at all, then it goes up. Then they're kicking themselves. Their
Yeah.
wife's mad at them for it,
And then you come
and
in
they
big
and they
later,
go
right?
crazy. I mean,
Yeah.
I've seen people want to put their whole IRAs in it, and so yeah, managing that the psychological aspect of being a financial advisor is something that I think I've gotten better at over my career, and it's important consideration there.
well, if it performs like it has in the past, you only need a 1% allocation. Pretty soon that'll be
Right?
half your portfolio.
No kidding. I
Is
mean,
that the,
they
the the NGU technology that they're using? Have you heard this?
No,
Oh,
uh,
it's number goes up is that's the technology that's the play there.
yeah.
I don't think it's even a joke, actually.
so Tim, before we came on, you were talking about you were selling down some of your bank holdings before
Yeah.
earlier in the year. What prompted you to do that?
Well, I mean, valuations started getting pretty stretched. Been pretty long the banks for quite some time. We tend to, buy them, especially when they're trading at discounts to tangible book value, as long as profitability looks good. We finally were able to cash in on some of our European banks, so like BNP Paribas, Deutsche Bank, Barclays. They had really good runs. I still like a lot of those. I think the fundamental outlook's pretty good, but the valuations finally caught up to kind of our estimate of intrinsic value. And whenever the market catches a cold, the banks get pneumonia. And so, for us, once they get close to fair value, I don't think they're the greatest businesses in the world. So it was an attractive time for us to sell. Citigroup's another one. I think intrinsic value is probably close to maybe a slight discount to tangible book, which is around 90. We sold in the 80s, probably high 70s to 80s, just because, that stock, whenever something happens, it gets clobbered. And I think it did dip in the 60s again or whatever. We sold some puts, we took advantage of volatility. And so we're kind of, established some types of conservative positions in them again, but not really playing it too much. I think that they're pretty close to fair value right now. But it's interesting finally seeing Europe catch that bid. I mean, I know you guys have been talking about it, and I have too. The value nerds, just the arbitrage between European valuations and U.S. valuations, and it's finally see that come to fruition a little bit.
I saw just not even on European valuation, but someone was comparing BYD and Tesla,
Mm.
and BYD's revenues now, I think, exceed Tesla's,
Wow.
and the market valuation for Tesla's like 10 times BYD.
Is it still? Wow, I'm a little bit surprised to hear that. I know BYD's been such a monster for so long.
I that was a tweet that I read that from. I haven't independently verified that, so
So that's as good as truth.
You're
I'm
probably
just
right.
Yeah.
repeating falsehoods here.
Yeah. It's well.
So what do you think is interesting, Tim? Do you see any? You're saying that there's a lot of overvaluation, but what's sort of
Uh,
relatively interesting?
yeah, I
Some
think there's
pockets.
pockets of opportunity. So one area that I like real estate investment trusts right here.
Mm.
I mean, people look at those businesses and they're not the sexiest necessarily, but look, they have lease escalations where, you're getting 2-3% increases in revenues each year. So depending on what area of the market you're in, something like Avicii Properties where you got, 5.6, 5.7% dividend yield and 100% occupancy, 100% uh, collections, and they're growing at a reasonable rate, high single digits, low double digits type returns moving forward. And these things, they've taken dips over time, like Crown Castle, another one, wireless towers, that they got hit really hard. They kind of did some restructuring, and that's one where we were kind of able to take advantage when it got cheap. Both those I think are closer to fairly valued now. One stock that I think is criminally undervalued right now is Alexandria Realty. So that is a kind of a life science technology REIT. So they house a lot of, like the Modernas, a lot of these really high tech biotech type companies, and they have the real estate for the labs and the office facilities. And these are not work from home businesses. I'm sure obviously they can do some stuff, but it's not something you want in your garage refrigerator necessarily. And I actually say that from my experience because my dad was a biochemist, and he'd have like these things in the garage refrigerator. I was like, don't touch, don't drink. Like, so I don't suggest that. But yeah, I mean, so that company there, you got RFK Jr., you have a new administration that looks at kind of the vaccine regimen and the Wuhan lab, and they look at it a lot differently than the past administration did. And so there's a lot of pessimism in the space. Biotech stocks as a whole are kind of, beaten up. And so the market's kind of projecting that, look, there's too much supply. They're not going to be able to, fill all their buildings. And so the stock's gotten really cheap. So this is a stock that used to trade at like 16 times cash flow to up to like 36 times cash flow. The stock was over 200 just a couple years ago for a couple years in a row. It hasn't been this cheap in, I want to say, over a decade, something like that. And right now it's trading at about a little over 9 times cash flows. It has a dividend yield of 7.8%. The dividend is really well covered. It's got one of the best coverage ratios in the industry, an investment grade balance sheet. And they're focused on clusters. So, around MIT, around San Diego, the top scientists, they tend to, gravitate towards the Bay Area, these certain areas. And so it's a clustered approach. It's very different than traditional office space. And so that's one. I just wrote up a research report on it for Seeking Alpha. I haven't done that in a while, but I've been adding a lot to it. Definitely down on it. It's been one of kind of the few big losing positions year to date, but it's one that I like quite a bit. I think it could double, and you get 7.8% dividend while you're waiting.
How interest rate sensitive do you feel like a lot of the REITs are these days?
It just really depends. So they have long-term leases and they have long-term debt maturities. They just did a debt issuance when rates were a little more favorable, kind of pre-tariff, at 5.5%. So that was a solid financing for them. But so you got to look at the debt maturities for these ones, their liquidity. A lot of them, they fund themselves through disposition programs. So they fund kind of their new development by offloading non-core assets. And I think that's one of the negatives in the industry is that sometimes those non-core asset sales might not be at the most advantageous prices because they're in some ways, some of them are somewhat pressured sellers, let's say. And so that's something you got to watch. It's a good question to watch, but I feel good about that balance sheet. It's an interesting company. I mean, it has the office tinge associated with it, but they're not a company that's going to see, revenues and earnings just plummet from here. And it's just so cheap. So that's the type of thing that we're finding attractiveness in.
What
I
what
mean,
has happened to office more generally? Have you followed that?
Come back, man. I mean, if you look at the stocks, I did some distressed, like preferred stock plays, bond plays on like Vornado. That was one of them, and SLG Realty. But this was a couple of years ago, when office, it was like kind of peak work from home, and people were really questioning the viability of a lot of those companies. And we bought some of those at double digit yield to maturities, and Vornado was still an investment grade company. I don't know if it still is or not. I believe it might still be. And so those were really attractive. But now the stocks have rallied a lot. The preferreds have rallied, the bonds have rallied, and so there's less opportunity there, in my opinion. But yeah, I mean that was an area where, I mean, obviously it's so clear what the bear case is, but at some point the valuation gets to
Yeah.
a level. People are moving back. I mean, there's a lot of people that move to Florida, and I mean, I love Florida personally, but they move there and they miss New York. They miss New York. They want to go back. They can't deal with the. I mean, I guess it's hot in New York in the summer too, but they don't like the humidity and all that stuff. That's more present, I guess, in Florida, more consistently. So
well, Jamie Dimon says you got to come back to work. Then
yeah,
what are you
yeah,
gonna do?
and
You got to
a bunch of them. Isn't Amazon saying that too? I think. I mean, even some of those companies. So yeah, I think that those are huge, huge movers, and then people copy it. So I think it's a positive thing.
Do you think those are layoff programs disguised? Like people won't come back, so they
Oh
Mm.
my gosh, probably. That's
just some
probably really
attrition.
smart. Probably a lot of the more obnoxious employees are just not willing to
The
conform at
headlines aren't
all.
as bad.
Yeah, but I can't talk. I like working from home too. It'd be hard to adjust back to a normal office grind. Again, fortunately, kind of owning their own business and focusing on research and analyzing companies. It serves me best to be at home usually. But yeah,
What do you think more broadly about, we've had we were in a bear market. We were down 21%. We've had this pretty violent rally. It feels like I mean, I don't, it's not as frothy as it was in 2021, but it's pretty frothy out there.
it is. It is. Well, it's interesting because when the sell-off was occurring, I mean, like always, there was a lot of panic, a lot of paranoia. You know, a lot of it's kind of politically driven. I think if you don't like the administration, and then the administration comes out and says we're going to do this tariff regime, and then all the news media is like, well, Trump's tariff war and Trump's bear market, whatever. There's some people, if you agree with that mindset, they're going to be like, sell everything. And I did have that. I had people that were like, I mean, why don't we just get out of everything because it's going to keep going down? And Toby and Jake, you guys know. I mean, people say this almost every severe bear market. I remember it during COVID. I remember it in 2011 with the sovereign debt crisis. Of course, 2008. They always think that they can pick the timing of that, and the reality is that you're not going to do that. You want to do your risk management prior to the sell off, and so that way, when you do that, when you're properly, when you've managed the risk before by owning bonds, by selling stocks when they're trading, at your estimate of intrinsic value or in excess of that, then you're able to actually play offense when you get these types of sell-offs. And so fortunately, that's what we were able to do. It doesn't always work like that, but we were able to, like, when the VIX was rocketing, we were able to like sell puts on stocks that we would be glad to own anyways. And that's a really good way to get a higher margin of safety, really attractive premiums. And if we end up owning the stocks, that's great. Same thing, just buying stocks outright when they're getting cheaper as well. But now we've seen the recovery, a little complacency's kicking in. One thing I really didn't like over the weekend was allegedly there was an attack, a drone attack on Putin's helicopter, and and so then there was intense bombing in Kiev. I'm not making a political statement here, guys. No one write in the comments. I'm just saying that the narrative, one way or the other. And so then there were heavy attacks on Kiev, and now even Trump, who's been pretty optimistic about ending that war, he seems a lot more pessimistic. And to me, that's a huge negative. I mean, like, I was really hopeful that we could put, that terrible war in the past. So that's something that I think is worse today than it was, a couple of weeks ago as far as the outlook. So I'm being cautious, guys. Like, I don't think it's a time to be super aggressive. That's for sure.
Yeah, I don't know that there's a lot of opportunity around either. The only things that I can find are the energy, I think, because it's so beaten up and the energy stocks have all been smashed since 2021, but then it's still a commodity. You're still sort of relying a little bit on some sort of geopolitical event or strengthening the economy to sort of make oil and gas work, whereas, it's not just a simple growthy little business that compounds away.
I would agree with you. I think energy is another one. I would have named it. I think there's opportunity there. You look at like a Devon trading around 30 again, and I mean that's a big discount to its net asset value when you look at the properties and the cash flows and really solid management team there. And so, how do you play it? Do you just, if you own the stock, obviously that's probably going to give you the most upside potential. Our firm, there's a lot of kind of implied volatility priced into some of these energy stocks because exactly you've got OPEC increasing production. You've got drill baby drill in the United States. And I mean, so it might make sense for us kind of to do the cash secured puts type thing and hope we could get in at a cheaper price or target like a double digit type return but just owning the stock outright, I think you'll do pretty well on a lot of those.
So you say the volatility in the options is already sort of making the options
Pretty
expensive.
high. Yeah.
Yeah.
Yeah. Like I think a lot of people are bearish. I would imagine short interest is probably high. And so I mean, we sold some puts, for instance, today on Devon Energy. I think we sold them at like 27 and a half or something like that for January. And it was low to mid teens annualized returns, and then your break even's probably around 25, something like that. Which for us, I mean, we're happy to own that stock at that price. Um, a lot of people don't like, a lot of institutions, they're not going to mess around with the option stuff. And so we manage like 170 million. So we're mid-sized boutique type investment advisory firm. But we're able to do things like that for our clients. I think it's a competitive advantage versus some of the larger firms that are more constrained, I would say.
Yeah, for sure. I like those strategies.
It's the workouts, man. That's kind of one of the ways I found it. It was like Buffett, what did he do when he had the partnership, right? He had the general investments like the, American Express or the Geicos or that sort of thing. And then he had the workouts like blue chip stamps and things like that, or merger arbitrage type things. And I feel like with options, you're kind of able to simulate some of that because there
Yeah.
is, a time element to it.
You can embed the return and you know what your downside is. And if you're happy to own the stock at that level, then it's a win-win because you can't even buy it in the market at that level.
Correct. Yeah. I mean, and if you do it with a fundamental basis, and I believe I'm right, but one of the things that really got me interested in it was I believe when Buffett was buying Burlington Northern Santa Fe, accumulating the stock, I believe he did it with cash secure put options at one point, and I do believe he might have done that with Coca-Cola at one point, but I'm not
Mm.
sure about that. That might have just been something I've heard, and I don't know for sure.
I haven't heard that before, but you heard that, JT?
I haven't, but maybe AI hallucinated it.
I was before AI.
Okay.
I've definitely like, I'm pretty confident on the Burlington Northern Santa Fe, and I mean, it was a small amount, right? It wasn't obviously how he built, such a large stake, but I believe that he was doing that. He's
I mean,
so
he's
big.
he's
They're so
done it.
big.
He's done it in private transactions too,
Yeah.
with families. Like carving out part of it can be put later at a different
Hmm.
price.
Yeah. True. Yeah. Exactly. The gas station one. Yeah. That they did that.
Let me give a quick shout out around the horn. Winter Park, Florida. Buffett's calling in from there. Good one. Toronto, Lausanne, Switzerland. Limerick, what's up, Com? Valparaiso, Max in Valparaiso. Bixby, Silicon Valley, Miami, Jupiter, Florida, Bethesda, Tallahassee, Ostermalm, Sweden, Sacramento, Kennesaw, Georgia, Nashville, Tennessee, Boise, Idaho, Snowdon, North Wales. Wow. Oregon City, Goshen, Indiana, Antwerp, Camus, Jebel Ali, Palm, Dubai. Good for you, Samson. Prague, Czech Republic, Saskatoon, Vienna, Austria.
Oh, good
Uh,
day, mate.
Tyler Cohn says the Vornado senior unsecureds are now BA1, triple B minus, BB plus, stable, negative, stable.
Hmm. Yeah.
So
Yeah, I
question
wonder what the yield to maturity is now. I bet you it's probably around 7 is what I would guess. But I mean, those were double digits, high nines for quite some time.
Torino, Italia. Good one, last one. Do you have any thoughts on natural gas?
I mean, clearly with all the AI stuff, it's the right energy, at the right time. It's just how do you play it? And these companies, I mean, they produce so much natural gas almost as a byproduct of their, oil production and stuff like that. So I don't have a strong conviction on it. I do like the MLPs. We had a lot of success on buying like EPD, ET,
Yeah,
MPLX, like they had a really nice run. The dividends are still good. I mean, they're still covered. I mean, they've had a big run, so it's almost sometimes they do get hit when the commodity prices go down a little bit, and then they've pulled back a bit. But I like that space a bit. The K1s are a huge pain in the rear though for
Yeah, that is
for
a
retail investors. I mean,
real
they
issue.
hate it. I hate it personally, too. But what are you gonna do? You can do
yeah,
the
those K1s are
ETFs,
a
I
nightmare.
guess. The ETFs are more favorable for that, but
Tougher on the manager.
yeah, it's not ideal. Do you ever do those? Do you ever do the MLPs in your fund, Toby?
I can't talk about my fund specifically,
Okay.
but
Okay.
If theoretically, would you
yeah,
potentially do that?
I don't have to take I don't take the K1s in there.
Gotcha.
That's all handled in the
Gotcha.
back office. But yeah, I
Gotcha.
have had some if you can't get exposure to mineral to looking for a particular business, if the criteria line up, then yes,
Makes sense.
yeah, they
Gotcha.
go in.
Okay. Okay.
So like it feels like there's a little bit of trouble at the top end of town to me. Like it feels like the Mag 7 have been a little bit shakier this time around, although, to be fair, so it's deep value. Nothing's really kind of done particularly well. I've been surprised, like the bounce seems to I don't know where the bounce has been in this most recent run. I've sort of seems to be in the index, but
But
Nvidia's
you can't
bounced
find
a
it
lot.
anywhere.
Yeah, Nvidia's bounced a lot. I mean, that went like in the 80s, I believe. I mean, so some of those have had, and then now it's at 135. So some of those have had pretty big runs. Microsoft, the Mag 7 one that I think the value guys are attracted to, including me, is Alphabet. I
yeah,
think that one's, trading at a pretty attractive multiple. And I get the bear case. I mean, AI obviously is going to have a major impact on search. It kind of reminds me a little bit. I was thinking about this today at the gym, actually, was kind of reminds me of when Microsoft had to transition to the cloud. And people were like, well, I mean, all these software applications, how are they going to transfer to the cloud? And honestly, that was kind of in my too hard pile at that time. I didn't really understand it that well as I should have. But I kind of feel like there's a good chance that Alphabet will be able to parlay, all the different things that they're in to be, still really, really competitive. And the valuations obviously come down quite a bit. So they might be able to play some offense too. So I kind of like that stock.
yeah. Without having looked too deeply at it, I tend to agree. There is that risk that people just aren't searching. And so if your interface with all of the internet is now through a AI chat window,
Do you
then
not
maybe,
search? You don't search anymore? I
well,
still do.
but we're not the kids, we're the wrong generation, I think. Like you
Oh,
and I
well,
probably
that's true.
do you use a
That's true.
desktop? Like the kids don't use a desktop. They do
Oh,
everything
good
through the
point.
cell phone.
Yeah, it's like
I type it
TikTok.
into the
It's all
search bar.
TikTok.
Well, I heard an interesting stat over the weekend that um, so previously Google used to trawl and they would deliver a click for every two hits on a page. And then that's changed to about a click for every six hits on a page, which is like the click is the thing that translates into ad revenue for the
Mhm.
content provider.
Mm.
So you need the
Are people just
clicks.
getting their answers now in the
Yeah.
Gemini box above?
Yeah. But
Okay.
for ChatGPT, it's like one in 1500. There's one click for 1500 web crawls. So like that sort of content provider being supported through ad services seems to be like that seems to be going away.
Yeah, I mean the it was always a bit of a strange bedfellow to have the advertising along with information together, and it had to come in kind of a package with Google. And so, like, 'cause you're always serving two masters: the user who you're trying to provide answers to, and then the company who's trying to buy eyeballs. And you end up with you kind of have to make trade-offs there.
But if they're for profit, the AI companies are going to run into that same issue, right? Like they're going to want to do the same thing because it's going to make sense to the bottom line.
Yeah,
Just like
what's
They
that
could,
saying?
TV,
Like on a
TV.
long enough timeline, everyone sells advertising.
Right, exactly,
That's
exactly like TV commercials. I mean, yeah, they pitch what they're incentivized to pitch, pharmaceutical commercials, So I don't know. I would think that that'll continue. I mean, it's trillions of dollars. It's just trillions of dollars in that market.
but I guess the ChatGPT can serve it in the window that it serves its answers, and it doesn't necessarily filter through then to the actual content provider because they're just sort of like taking a group and finding the median response out of that group. I don't know if that's actually how AI works. That's my explanation for it, but that's how it writes to me. That's what it looks like it's writing.
I thought I
That
was so
just
smart. My wife, her X5, it needed a new air conditioner, and so I was like, oh, I'm gonna use one of the
AI.
AI ones, and I'm gonna find local shops that can deal with German cars because I didn't want to take it to the dealership, and I gave her like a list of 10, and I'm just feeling, oh, I'm so prepared. Like this is so great. She literally called like seven in a row, and they were all closed, or I mean, just none of them were, zero of them were accurate, none. So
huh.
I don't know if I'm doing something wrong, but I kind of old fashioned, I guess. I'm not that impressed with a lot of what I'm seeing. For some stuff though, like I'm sure like legal documents or like what David Solomon of Goldman Sachs said that like preparing like an S1 for an IPO,
Mm.
they can do like 90% of the work in like a couple hours where it would take weeks of a whole team engaged to do it. So stuff like that, I guess they just can't find auto repair shops.
I
Well,
do think,
Toby, like
yeah.
what percentage, when you were a corporate attorney, what percentage of work that you did was just find and replace?
Well, you start with the template, but the things are, like even an IPO, which is they call like that's a pretty straightforward document because you've got a prospectus and you've got filings and but then you've got to find supporting evidence for every sentence in that prospectus, basically. So it's highly, it takes a lot of touch to get that done. But then I think that that's something that AI could get done if you can like put the universe of documents into the project and then instruct it to only draw from the project. That's probably something it could do well. That's a lot of work. But the AI, like if the AI gives you a first draft and then you just got to verify what's in the AI, like, yeah, that chops out a lot of work.
I mean, LegalZoom, I mean, that's basically it's all templates, like you just said. They simplified it and made it super easy to do. And yeah, AI can do most of that. I just wonder where like I mean, if there's a mistake, I guess I'm not
Yeah,
sure
who
who'd be
can you
responsible.
sue?
The
Yeah,
lawyer, yeah, if there's a mistake and you haven't used a lawyer, that's what the lawyers are for. You access their insurance.
yeah,
Yeah, it's a
that's
big
true.
big part of it is yeah, who can you sue in this to like keep it honest?
I mean, the bigger problem is if the car crashes, who do you sue? And I think that's one of the things that Ajit Jain was talking about at the last meeting.
Yeah.
They're going to have to work with regulators and work with autonomous
OEMs,
driving to
yeah.
figure out. It probably like my bias is based on all of the like that research that I've done for the other books, quantitative value and so on, that it's probably highly likely that the cars have fewer accidents, but it's possible that they have worse accidents. I don't know, but I think that,
Mm.
or I think that it's possible they have fewer accidents, and so it's a net benefit for society.
I believe that to be the case. I mean, we had a tragic accident in a community, and it was someone like reaching for the phone and kind of ran into a truck, and the truck basically like towed and crushed him, unfortunately.
Hmm.
And yeah, I mean that's something that maybe like the AI wouldn't have. But then I saw there's a basketball player, an NBA player whose son sadly died in a crash in a Tesla. And according to the former NBA star, he said that the wheel just like went like limp. And
Hmm.
so I don't know for sure. I mean, I guess they track the data and stuff like that, so maybe he does know for sure. But it's like that's also really scary. It's like, okay, through no fault of your own, maybe, just like the robot took over and crashes you and kills you. I mean, that's scary. That's definitely scary. I mean, we all understand we're going to make mistakes on our own. So yeah, it's a tough. They'll thread the needle, but that's probably why it's taking so long, is like the liability issues, like you mentioned.
Does seem to be some Waymo around though. Like there's Waymo in Arizona, right? That's where they
There's
tested
so
it.
many. There are
Yeah.
so many. It's kind of creepy. Yeah, I mean, they'll just one time they just pull up like right behind you and it's like staring at you. I was like walking
Yeah.
around downtown Scottsdale and like this one just staring at me. I thought it was like a police one or something. But yeah, they're all over. But I didn't see them as much in Orange County, California. But probably in the Bay Area too. I think they're all over.
They're definitely in San Francisco. They only have 4 seats though, so it didn't work for me and I got five and my little family. But we were trying to catch one, and they're now available in LA too, but not in my service area. They're only
Mm.
down in Santa Monica, that kind of area. But I will get in one by myself. Probably won't try and kill the whole family on the first
Just
go,
you,
but
Yeah.
yeah.
save that for later.
Some of these cab drivers and Uber drivers, I mean, really, it's
Well, that's
it's
true.
scary either way.
Well,
Yeah, for
they're
sure.
day trading Bitcoin on their phone while
Oh
they're
my God.
driving, right? So it's
Yeah.
like what's more dangerous?
Yeah. Ignorance is bliss sometimes.
Yeah.
So what do you think about this market, Tim? Like, what are your
I think it's, look, I like high cash flows and dividends right now. So I think there's still opportunity to get really good dividend yields. Well, one area that we targeted, especially in the dislocations during the bear market, was some of like these business development companies, like a Blue Owl development company, OBDC, for instance. When they trade at reasonable discounts to their net asset value, they kind of like that. You're getting a 10, 11% type dividend, and then you're getting it at a discount to their net asset value. Now, if you get a recession or something like that, those companies are going to face higher credit losses for sure. I mean, can't be naive about that. And some of them are better underwriters than others. I think that one's decent. Like Oak Tree, for instance, they've been a really poor underwriter with like their business development company OCSL. They've had increased losses just about every quarter, and the net asset values been plunging at a rapid pace, and it's been kind of a value trap. So the ones that are well managed, and if you can buy those at a discount, target a really high dividend yield, and then maybe get a little bit of appreciation and kind of hope that credit stays reasonable. I'm not as bearish as a lot of people are of the economy. I think that the tariff situation is going to work itself out one way or the other. I don't think it. I mean, clearly, it's not like winner take all type thing that people were worried about on the day of the announcement, right? I mean, they're obviously compromising and wanting to do deals. So I'm not super bearish on the overall economy. I feel like we should have been in a recession many times over the last few years. So if we do dip into a technical recession, like that's not going to really change my investment thesis whatsoever. But being smart, buying them at discounts to net asset value, I think that's opportunity.
I tweeted this out earlier today, but I just thought it was kind of interesting. It was from Mike Shell, and he said US recession probability dropped to 30%, which is still pretty high. Like the 20 just before the 2017, it got to 40%, And in 2020, it got to 40%. So at 70%, and it looks like it hit 70% sort of late last year, maybe 20 sometime 2024. And so it's bounced around like 60% since then, now fallen to 30%. But I tracked in 2020.
What is that based on? Just they're polling economists?
That's a good question. U.S.
'Cause
recession probability. It's a U.S. RPEM. That looks like an Edgar series.
Hmm.
That's IUSRPEM. If anybody wants to verify that.
To the negative side, I mean, one clear negative, and unfortunately, I'm totally exposed to it. As I mentioned to you guys before we went on the show, I'm selling a house and then I just bought a new house. So I'm way leveraged to residential real estate when I'm actually bearish on it, but life happens. But I mean, the housing market's had a material change. And I mean, obviously that's local. It depends on the area, but like houses are staying on the market a lot longer. Finally, people are kind of feeling like they have to make a change. It's great having a low interest rate, but maybe you got to move for work or family stuff or whatever. And so there's more supply coming on board, but the houses are sitting a lot longer and price reductions are occurring a lot more rapidly than they were before. And so that's an area that I think a lot of real estate agents or mortgage brokers, I mean, they'll tell you the mortgage rates being, above 7, that's
kills
highly
it.
problematic to getting those deals done. And affordability is just still so terrible. So that's one area that could point you to the recession card for sure.
Yeah, it seems to be very sticky, those prices, even though rates have gone up a lot and volumes have fallen off a cliff, and mortgage volumes have fallen off a cliff too. Mortgage origination's fallen off a cliff, but the prices haven't budged.
I mean, if a realtor tells you your house is worth $2 million and then you can't sell it and realistically the clearing rate's $1.4 million, that's a tough pill to swallow. I mean, you take the word for granted, and so yeah, it takes a while for people to take those reductions, but they are reducing prices and houses are sitting on the market now, and buyers are seeing that they have a little more flexibility to negotiate. So that's hugely negative, I think. I mean, real estate can really drive stuff, and with affordability so bad, you start to see prices go down a bit. Other areas like auto loans, like I've Ally Financial, that's a stock that we've owned a lot over the years. We're not super in it now, but we have positions in it. I like it. I would like it more in the 20s. But auto loan delinquencies are very high for the industry in general, not necessarily for Ally particularly by any means, but for the industry itself, that's high. A lot of these, I'm not an expert on it, but a lot of these kind of like student loan deferment programs. I was talking to one of my neighbors, and he's a doctor, and he's telling me, we're playing pickleball, and he's telling me that, Tim, I haven't paid any of my loans off. Like I have all the money saved up. It's in a high yield savings account, but there's some program where, I think probably waiting for potential forgiveness. I don't know.
Yeah. He's
But
just
where
doing a
they,
carry trade right now.
right, just a carry trade. I'm like, well, you're smart to do the carry trade, like I get it. But he's like, yeah, I'm ready. We're ready to make those payments. I don't know when stuff like that comes
That
due,
would be
but
unusual, I would think, having saved up to make the payments.
oh, for sure. Yeah, that
Yeah.
like to handle it responsibly. I'm sure there's a lot of people going YOLO, but maybe they're making a lot of money on Bitcoin or something. So who knows?
Tim, back to your comment on like the like lack of liquidity and at prices of today, really, which is driving a lot of this. It kind of feels like that's sort of pervasive in, I mean, I think there's a lot of private equity that they don't want to sell at today's prices and take different marks on it. There's, venture, I think falls under that. It just feels like everyone, maybe it's part of the echo of a bubble, but no one wants to admit that these are maybe not the right prices anymore. And as long as everyone sort of agrees not to call each other out on it, you can sort of just hover there for a while, like Wile E. Coyote, running off the cliff.
Right. Oh yeah. What forces your hand? I was talking to a prospective client, and he's big in apartments, and so it's a lot of these companies, a lot of these smaller businesses, they created like syndications, and they would buy apartment buildings, and they'd use variable rate debt to finance them. And so that's one of the ways that supply increased a lot over the years. So not necessarily the most established or largest or more sophisticated necessarily entrance into that space. And so, I mean, it's crazy when rates are going up, his ability to invest just goes down completely because he feels like he has to keep all liquidity to service these loans because the rates increasing so quickly. But then when we do get kind of a dip in rates, then he feels more aggressive and actually wants to do other things and diversify more and stuff like that. So that's a big issue. I mean, if rates don't come down, that's gonna pressure a lot. And at some point, you still have a lot of arms and stuff like that. So at some point, these loans, probably like 2028, some of those loans are going to be needed to refinance anyways. So we'll see what happens. But rates,
JT,
the long bond, that rates going up on that really hurts. It's good that Japan did something today that kind of reduced long bond rates. I'm not exactly sure what they did, but that would be positive if rates went down.
Everyone back in the pool.
Yeah.
JT, we slipped past the top of the hour without doing
Let's
vegetables. Sorry
let's
about that.
take our veggies.
Market fellas, 11 minutes past the hour.
All right. So this segment's inspired by Matt Ridley's new book, Birds, Sex, and Beauty. And Ridley's one of my all-time favorite authors. I think I've read everything he's ever written. So to paint the scene for you, imagine it's early morning on the grasslands of South America, and a dozen male birds gather in this open patch of dirt, each holding down a little postage-sized stamp, basically, of territory. And there's really nothing special about this land, except generations of birds have been coming here for decades. And the birds jockey around for the territory, and occasionally the fighting can get kind of intense. But mostly they respect each other's kind of little sovereign areas. And when they leave to go find food, they'll travel together like friends hanging out. And then when they come back, they all get back into their little spots that they had previously held. So every morning from roughly like March through May, these birds gather in a cluster in these little chosen areas. And it would be quite boring to watch most of the time. But then out of the blue, you're sitting there watching and they all start dancing. They puff out their chests, they flutter their feathers like they're sequins. This whole scene looks like a cross between a Vegas floor show and a nature documentary. And they're definitely not fighting at this point. They're not trying to show each other up. They're not feeding. They're trying to be seen because somewhere nearby there's a female who's watching, and what they're really trying to do is find their way into another F word. Strangely, though, dozens of males will perform, but only one or two do most of the mating with the females who come and watch. And these females are very selective. They'll watch the males put forth their best show, and then they'll leave, and then they'll come back the next day and the next, and then they're really in no hurry. And the females are definitely in control of deciding like who they want to pick. And eventually they choose their next baby daddy from this gathering of males. And this whole phenomena has a name. It's called lecking. And like the little area that they go show up is called a lek, L-E-K. And many species of bird lek, several varieties of grouse, the manakin, the ruff, but also some mammals, including the fallow deer and a species of fruit bat. So you may be wondering, why is the mating so skewed to just a few of the males? If you watched, you wouldn't be able to see much difference between these males that are gathering together. Their behavior is the same, like they look the same. Even these alpha males aren't really healthier than the other ones, as far as scientists can tell. They tend to be a little bit older and therefore bigger, but that seems to be mostly a lot of luck and randomness in the female selection. And there's this interesting evolutionary idea here called the sexy son hypothesis. And the females aren't just picking based on their own personal taste. And they're certainly not picking with the hope of pairing up with the bird equivalent of Fabio and living happily ever after. In fact, the males contribute almost nothing to the child rearing more than the few seconds it takes to copulate. But the females they're picking based on what the other females in the cohort are also finding attractive. So if all of her female peers think that this one particular male is sexy, chances are maybe the next generation of females will too. So they're all choosing the same male in order to increase the odds of having a sexy son. So even if another male might be slightly more fit, it doesn't really matter. She's betting on sex appeal because that gives her sons the best shot at being chosen in the next round. Hence the name, the sexy son hypothesis. So let's leave the savannah behind for a minute and let's head to San Francisco. Startup founders gathering at demo days, investor summits, coffee shops. They puff their chests out with techno jargon. They vibrate their feathers looking for product market fit. They dance forth grand visions in their pitch decks, all within this small, like 3 to 4 square mile patch that's the heart of San Francisco. And it's really a modern day Lecking environment. And the goal of these founders isn't necessarily to find natural selection of building an enduring business. It's the sexual selection game of getting chosen for the next funding round. Most of these entrepreneurs won't make it despite their fancy displays. A lucky few will get funded by the venture capitalist females in this analogy. So when a top tier firm picks a startup, it triggers this cascade. Other investors, like rival females in a LEC, start to notice, and suddenly term sheets are flying in and piling up, valuations are ballooning. Being chosen increases the likelihood of being chosen again, just like in nature. And just like in nature, this sexy sun isn't necessarily a business with the best fundamentals. It's the one with the best odds of attracting more capital down the line. So you think about the PayPal mafia with Musk and Thiel and Hoffman and others. They didn't just succeed once. They became fundable again and again. They produced new companies, new founders, entire VC theses. And there's another concept from biology that we'll hit right now that also you might see from observing bird mating. And it's called the Fisherian, like Fisher, runaway selection. And so a small preference, say a bright tail, snowballs over generations. And these traits get exaggerated because both the signal and the preference are heritable. And this biologist, Ronald Fisher, worked out the mathematical proof in the 1930s of how runaway selection can occur from persistent directional female choice. So that's how you get that iconic example of a peacock with their tail that they can barely fly. But it shows up in other species like the stalk-eyed flies, swordtail fish, and lots of other birds. And the females are drawn to something interesting that maybe is like slightly bigger, shinier, something. And within a handful of generations, you get some appendage that bumps up against the odds of practical survival for this thing. So back into the VC LEC, runaway selection, gets you these startups with $10 million seed rounds and 100-person engineering teams that only exist for valuation purposes. But why should this Lecking analogy matter? Because if you recognize the dynamics, that there might be some unknowingly amplification of traits that are creating fragile businesses. So what do I mean here? Each investment round isn't necessarily just about funding the company. It's setting the standard for what attractive looks like in the next generation of founders and investors. And that feedback loop can then start to unintentionally prioritize showmanship over stewardship. So we'll consider the trope of Theranos. Elizabeth Holmes had this carefully crafted persona with the Steve Jobs black turtleneck, high profile board with all these luminaries and dramatic.
Deep voice.
Yeah, the deep voice, exactly. And this runaway selection created a caricature of a founder that Fisher might have anticipated. Similarly, FTX used celebrity endorsements, stadium naming rights, high profile sponsorships to signal credibility, which really was anesthetizing the need for rigorous financial diligence on the company. And then, of course, you got WeWork's lavish offices with Adam Newman walking around barefoot with these aspirational narratives of elevating human consciousness and, via community-adjusted EBITDA. All these powerful signals distracted investors from sustainable, actual financial models. And really, anyone who was kind of paying attention could see that when you have variable revenue of renting out office space on a hourly basis against very high fixed costs, that's a troubled business model. So anyway, the louder the signal, the bigger the hype, valuation, celebrity backing, whatever, the more investors are piling in and amplifying these small initial advantages into this overwhelming market perception. And this creates environments where irrational evaluations become rational because everyone anticipates future up rounds as far as the eye can see. But it also creates this vulnerability that, if you're reliant on these signals rather than substance, they can collapse very swiftly once the momentum fades. And I think we kind of see that a lot in all over the place. And so you get these spectacular implosions of companies like Theranos, FTX, and WeWork. And they're not really isolated anomalies. They're inevitable consequences of runaway signaling. And so just to wrap this all up with a pithy little take, VCs and others should probably be focusing more on funding actual flight and not just feathers.
Tremendous, JT. Sure to be up there with your sperm whale classic, given enough time.
Yeah, well, history will be the judge of that.
That's right. some of these private market valuations for these firms are amazing. Like ChatGPT, OpenAI at like 100 billion. And then they translated that 100 billion, and that's an old mark for all I know. It's higher than that now. Then they used that 100 billion to buy Johnny Ives like
Yeah,
design consulting
yeah.
startup for like 6.5 billion.
Wow, I didn't even see that one.
Was
That's
it that much
crazy.
of a number?
Well,
Jeez, I
That's
saw the
insane.
little
Mercer
like talk
reported.
about it.
So it's 6.5 billion. I don't know if you get that in OpenAI stock. I'd be asking for cash on the barrelhead, but
Yeah, cash, please.
probably that's not available. And
No.
then what they've worked on, the product is no screen because Johnny Ives is a design genius. They've gone
Mm.
and they've produced this thing that looks a little bit like a miniature spaceship hockey puck kind of thing. So it looks to me like they've made Alexa or something like that. So you get
Yeah.
Alexa for $6.5 billion dollars.
Wow.
I don't get it. I'm
How I want
not
one though.
not a VC.
Yeah, I read like a funny article on those, the Apple, like the glasses or something like that, like the virtual glasses, where if you wear them for like 10 minutes, you get like a horrible headache and stuff like that. And like these early adopters, they just can't stand using it and stuff like that. So, yeah, that's a big bet. But when money's floating around like that, I mean, look what Musk just did with Twitter. I mean, that's insane. Those banks were taking haircuts on the debt, and then he was able to combine it with the AI
XAI. Yeah.
company, and
XAI, yeah.
it's wild. It's incredible, and that kind of goes to what you were saying in your veggies, Jake. Is just that Musk is one of those attractive birds, attractive peacocks, where people believe that he's going to be successful with pretty much whatever he does. So it helps him from the corporate perspective for
And
sure.
as long as you can just kind of keep rolling the misses into underneath the wins, I mean, the game can keep going, right?
Yeah, the solar company. I mean, that's kind of
Solar
what happened
company,
with the solar company. Solar, was it Solar City?
Solar
Was that the
Solar
City,
one?
City.
yeah.
Yeah, I mean, merged it with Tesla, and I mean, I didn't Sunrun just go bankrupt. One of those solar companies just went bankrupt not that long ago. But I mean, I can't imagine the economics of Solar City would have been that good as a standalone enterprise, given the dynamics of that business. But intertwined with Tesla, you can have it be a loss leader for a while.
Yeah, he raised money into XAI and then he merged XAI into Twitter. And so he got to set a valuation for Twitter by doing that. And probably there was some capital from XAI that becomes available for the bondholders in Twitter. If he can merge that into Tesla, which I'm sure the Tesla guys are open to, it just
But yeah.
increases his
and then
ownership in,
into SpaceX, and then
Oh, the SpaceX is
yeah.
going to be I mean, that's a monster already. I mean, I can't even imagine what the market cap is, but I mean,
It's like
that's
100 billion.
incredible.
They're all
yeah, I think
100
it's
billion
100
At
billion.
companies.
least
Yeah.
I'd say conservatively 100 billion. So that would be my
Do,
guess.
do you like
What did
that's
actual
like the
revenue
market cap?
or
Yeah, like
anything
what it,
look like?
yeah. It's
I
got
don't know.
one customer, hasn't it? It's got like US government customer.
I think some of the companies that launch satellites and stuff like that use them now. I believe so. I know a friend of mine, he has a manufacturing business in California, believe it or not. And he builds a lot of materials for SpaceX. And I mean, gosh, I've seen his business just grow tenfold. I mean, it's
Hmm.
ridiculous how well they're doing. And I mean, some of it's good to see stuff like that manufactured in the United States, let alone California. And I think that they're branching into Blue Origin too now. So
How much working capital would you ever let get against a Musk company? Your AR for you.
They seem to have been, I mean, so far they seem to have been okay. But yeah,
No
it's
counterparty risk.
like there's still the possibility of a gigantic smoking crater at the bottom of all of that. I think it's not a
It's not
guaranteed.
zero. Yeah.
There's no zero's not taken off the table yet with the debt.
on
I mean
what?
just
Like Tesla or which one?
yeah,
Like, I mean, like if you look at like what he did with Twitter, I think Twitter is a much more viable business now than it was prior. I mean, a lot of people, regardless of your political affiliation, you're at least going to see it as more of a free speech platform than some of its peers. And I mean, I was a witness to that personally. Honestly, I won't get into it, but I think that what he's done is incredible. And I mean, he's brought back advertisers and things like that. And he created the premium memberships and things like that that I think helped enable it be able to be merged with, the other company and help it. But I mean, Tesla's economics are good. I mean, obviously him getting involved with politics alienated a lot of people and the sales are horrible now. So I don't know how that's going to shake out. And I mean, you look at like the used car prices for some of these EVs, and that's, an interesting dynamic too. But
What's happened to those? Have they collapsed?
oh, they've been plummeting for a while. But yeah, they're really bad. I mean, the resale values on a lot of those cars are just terrible.
Is that
And
because
now
they brought out new models? There are
they
new models that
haven't
just
though.
rolled
The
out.
models
It's
on like
range
the
decay.
Teslas are the same. Like the S and the Y, like they're the same. They look so generic in my opinion. Obviously you've got the trucks, which are pretty popular. But I don't know. I mean, I know at some point you have to replace the battery, which is really expensive,
Mm.
but I don't know.
Yeah.
I feel like some of these low tech cars are going to come back into vogue again because these expensive cars are these new modern technology cars are so expensive to repair.
I still prefer an EV to an ICE. I
I,
think it's
I'm the opposite, man. Like I have a IC a 7 Series BMW, and I had to get it repaired, and they had replacement cars, and there was like a big line, and all they had were EVs for you to, and nobody wanted them because I don't know how to charge it. I don't have a charger at my house. I have no idea how to go to the
yeah.
gas station and do it.
Once you get that charger though, it's a game changer. You just charge it
Um,
overnight.
It is
I think
nice.
Don't have to go to the gas station.
Never even think about like, do you have gas or not in the tank? It's
I
just
like
oh,
the
ready
smell
to
of
go.
gasoline, going to the gas station,
You're like
grabbing a soda, a
get
lottery
some two
ticket.
stroke.
Yeah.
Get
Get the weed eater out.
pack of
Yeah.
Marlboros and some
Yeah.
lottery tickets.
Exactly.
uh,
So I'm sort of it's the only I'm interested to know because I think that there's for the market from here, it's impossible to say, but it feels to me like all of the big drawdowns that we've had, like 2007, 2009, have this initial drawdown and then sort of a rally back to
little
almost all-time
reprieve.
highs. Yeah. And then the real action starts like 12 months after the first drawdown. So we're sort of I think we're in a funny no man's land here where we peaked in like November last year, like around Thanksgiving last year. We've had a big drawdown, 21%. We've rallied almost back to all-time highs now. So it feels to me like nothing's particularly undervalued. Nothing seems particularly interesting. And it feels to me like the economy is slowing a little bit, even though those recession odds have come down. Maybe that's backwards looking too much. But
Yeah, those are reflexive on stock prices.
I'm
yeah,
going on
but
vacation soon, so that's usually a good time to short the market because, you know,
Shit
look,
happens when you're
you
off.
never get to just relax and enjoy your trip when you're in this business. I feel like it's just the market tends to tank then. So yeah, I think you're right, Toby. There's a lot of complacency in there, and it wouldn't be shocking at all to see more volatility creep up. I mean, who knows if the EU and the US can come together on a deal? The China thing's, still out there. Are they really going to be able to come to grips with it? The geopolitical situation now with Russia's, I mean, that's really alarming again. That's a lot worse. I mean, the rhetoric coming out of there is a lot worse than it was a couple weeks ago when it looked like there might be a way to a peace deal. So yeah, and then valuations are high. Tariffs were the spark, but
What's
but
not to like?
yeah,
Yeah,
yeah, tariffs were the
that's
spark, but the Tinder was out there for a long time in terms of high valuations. So we're right there again, just waiting for that spark to ignite the next sell off, in my opinion.
even down 21%, I didn't think it was like that interesting. Just like it got to like 33 times on a Schiller PE, which, I know that there's lots of problems with the Schiller PE, but as like an example, like, you get the same answer from Tobin's Q or from the Buffett measures or anything like that.
Yeah, I would agree. I mean, stuff like JP Morgan, I mean, it wasn't even close to book value or anything like that. Normally when you get, I mean, think of just like the bank crisis the bank crisis a couple years ago. A lot of that stuff. I mean, that was crazy. You saw
Like the Silicon
huge
Valley Bank,
moves.
that one.
Yeah, and you saw huge moves on all of those insurance companies, things like that, where a lot of that started trading at huge discounts to book value. I mean, you look at insurance companies now and they're trading at, high premiums to book. And, there's credit risk on those, there's underwriting risk, there's stock market risk. So yeah, this is not a market that's screaming recession or risk aversion, in my opinion.
We're just about coming up on time, Tim. If folks want to get in
Tim, tell
contact
us
with you.
about your book also.
Yeah.
Oh yeah, so I wrote a book. It's just a short, little, easy read for you. You can find it on Amazon, but it's called The Business Mindset Investor, and it just kind of articulates how we kind of intertwine the deep value investing principles, kind of the Warren Buffetts, the Benjamin Grahams, and then we intertwine that with conservative income generating strategies like covered calls and cash secured puts to generate income and reduce risk. So you can find that on Amazon or on our website, which is just www.ttvalueinvesting.com.
We will link that up when we get the link to it in the
Cool.
show notes.
Thanks, guys.
And if folks want to get in contact with you or
Yeah, ttvalueinvesting.com. They can reach us that way. And yeah, we'd love to help you. We work with clients all across the country and manage portfolios for them.
JT, any final words?
Nope. Have a good week, everybody. We'll see you next week.
Thanks, Tim Travis. Thanks very much.
Yeah, thanks, Tim,
Thank
for
you.
coming.